In this video, we're going to be taking the 14 most popular real estate investing methods, and we're going to rank them on a tier list based on best to worst. That way you can decide for yourself which ones pose the most risk, the most reward, have the best pros, have the most cons, and which is the best fit for you based on what you want and what your goals are in your journey. There are so many real estate investing methods out there, so we've got a lot to cover, guys. Let's go ahead and just dive right in. If you're new here, this is the BRRRR YouTube channel and podcast. Free content dedicated towards helping you launch, scale, and grow your own short-term rental portfolio without having to buy any property at all. And over the years, I've had the opportunity to dabble in so many of these real estate investing methods that we're going to be talking about. Long-term rentals, buying short-term rentals, arbitrage, co-hosting. We're going to take our years of research and experience in real estate investing, and we're going to just lay out for you very simply what's what and which are the best. This is going to be really important for you based on your capital constraints and your goals. Let's go ahead and just jump right in. So first on the list is good old-fashioned long-term rental buy and hold real estate investing, single family houses. This is the traditional real estate investing vehicle where you purchase a single family home and you rent it out. So I'm going to go ahead and place this in B tier. Reason being is that this is one of the most beginner friendly real estate investing models, but there are a lot of pros and a lot of cons. Bottom line is you typically need to shell out a tremendous amount of capital. Down payments on regular long-term rental properties are anywhere from 5 to 20%, which very quickly adds up into $20,000 to $100,000. So it's very capital intensive, and a majority of the time the cash flow on these types of long-term rentals is just so slim. Without incorporating any of the other methods that we're going to talk about here today, traditional long-term real estate investing just does not provide a lot of cash flow. The return on investment is not substantial. You are lucky if it's anywhere from 8 to 15%, which isn't really that much better than the stock market. Now, the caveat here are the tax benefits and the long-term equity. These are the huge benefits of long-term real estate investing. So the cash flow is very minimal. The cash-on-cash return on investment is no better than investing in the stock market. However, the property will be worth a significant amount over time, especially when you factor in appreciation, and the tax benefits that you get along the way are really good for those that are high W-2 income earners looking to offset their taxes. So we don't love it, but we don't hate it. Long-term real estate investing is tried and true, one of the best beginner methods. We're going in B tier. Next on the list is house hacking. House hacking is similar to regular long-term real estate investing, but it is a unique creative strategy. This is when you buy a multi-family house, so either a 2 to 4 unit house, and you purchase it with the intent to live in one of those units while renting out the others. Now, the reason why this is such a popular strategy is because you're living in the unit, you can then finance the purchase of the house by using a very low down payment loan, like an FHA or a primary residence 5% down, which is really great. This lowers your upfront investment and allows you to purchase a property that has multiple cash flowing units in it. You get all the benefits of the long-term rentals that we just talked about, but the plus is when you move out of that house, you can then rent out the unit that you lived in, now giving you multiple units, which will typically exceed the amount of money that you need for your mortgage, hence providing cash flow. And depending on the property that you choose, if it's a 3 unit or 4 unit, it might cash flow significantly more than a regular long-term rental. Plus you get the equity benefits, plus you get the tax benefits all associated with the long-term rentals. The only catch and downside to house hacking is most beginners get into this without thoroughly understanding how to analyze what the projected cash flows will be after they move out and really assess the full situation. And because there are more units than just one, there's usually a lot more maintenance. However, I am putting this in A tier. This is one of the best beginner real estate investment strategies by far. This was how I entered the real estate investing world, and I strongly recommend this for anybody looking to build long-term wealth. Strongly. Okay, next on the list is the BRRRR strategy. BRRRR is an acronym that stands for buy, renovate, rent, refinance, repeat. So at a bird's eye view, what you do is you purchase a home that needs work. You then shell out additional capital to then upgrade the property and renovate the property. You rent it out to a tenant. Now that you've just renovated the property, the rents will be higher than originally projected. And then after you do that, you actually refinance the property. So this is actually pretty cool because you did what's called force appreciation. You renovated the property, you increased the value of the property. So when you refinance, you actually get to take out the value of the new value of the property. So for bad back of napkin math, if you bought the property at $500K, you renovated it, you put $100,000 in, now it's worth $700,000. So when you refinance it, you now get to pull out the equity based on the $700,000 value. Now, obviously this is just very generalized, but what that allows you to do is then pull cash out of the property. It still runs as a cash flowing unit. You take that capital, you put it in your next property, and it allows you to keep scaling. So this is one of the few purchasing methods of real estate that allow you to scale. If you've been on this channel before, I am very big on anything that is scalable and repeatable, because without that, you're kind of stuck. You don't really have the opportunity to keep growing your income. This is an incredible strategy. The biggest downside is the capital requirement, because in order for this strategy to work and for you to be able to pull out enough equity to buy the next property, you typically have to buy that first property in damn near cash. So if the property's 200 grand, you should have 200 grand ready to throw in it. Now, of course, you could pull together people's money, but the bottom line is you have to bring so much more money to the table with these types of deals, hence making them way more risky, especially for beginners. And that's not even including the additional money that you're gonna have to bring in to renovate the property, hence making it even more expensive and risky. So I love BRRRR, especially for those ambitious folks, but it is way more risky and way more challenging for beginners. I'm gonna go ahead and put this in B tier. It's very difficult to be good at this. You have to really understand what's known as ARV, after repair value, and if you mess up that calculation, you're gonna be screwed in this strategy. Okay, next we've got the tried and true fix and flip. This is when you buy a distressed property, you renovate it, then you sell it for a substantial profit because now it's worth way more money. I was always against fix and flips until I hung out with a good friend of mine recently, and I noticed that he was wearing a Nautilus on his wrist. This is an $150,000 watch, by the way. So the strategy does work, but it does require some expertise. Here's some of the pros and cons of fixing and flipping. The payouts in one flip, if when done correctly, can be substantial, like literally six-figure checks. You get strong renovation and deal selling skills, and you can really scale this with good capital and good crews. But the downside is it is extremely capital intensive. You have to buy that first property. You typically have to put in a substantial amount of money to flip them to get them to the point where these are really profitable. The market timing in this is huge. If you do this at the wrong time of the year, it completely destroys your ability to flip the property. And renovations are not simple. This is not like what we're talking about. This is not like HGTV where it's all fun and games. Often these get delayed by permits. This sets you back months. You're burning cash on the mortgage, and it's also really competitive. Look, fix and flip can be insanely profitable, but it's more like running a construction business than an actual real estate investing vehicle. So because of that, I'm going to put it in C tier. Okay, so now we're going to get in some of the creative strategies here. These are going to be some of the strategies that involve way lower capital and are a bit different and not as widely known. So next on this list is Airbnb Arbitrage. If you've been on this channel before, you've probably heard a lot about this. This is where you rent a property, typically a single family home or an apartment. You furnish it and then you list it as an Airbnb and you collect the profits because now you're renting out on a nightly basis instead of a monthly basis. Now, I'm a huge fan of this. And the reason I'm a huge fan of this is because of the scalability, the lack of capital component, and the cash flow. So by me renting properties, listing them as Airbnbs, it's purely all cash flow. Now, there is no equity. That is the biggest downside. And you are, at the end of the day, signing up to run an Airbnb business. So you do have to make sure you create the operational component very nicely. So again, my biggest gripe with it is there is no actual tangible equity in it. However, it is very scalable because you can rinse and repeat. Once you do it once, you set up an Airbnb arbitrage property. If you do it properly, they can generate you $2,000, $3,000, $4,000 per month in cash flow. And the best part is you really didn't have to spend much money on it at all. All you had to really pay for was the security deposit and then the furniture, which, by the way, the furniture can typically just be financed like we did. We just financed it with a 0% interest credit card. But when you factor that in, you might be all in security deposit plus furniture, $15,000. And if it cash flows $3,000 per month, that's 36 grand a year. That's essentially a 200% return on investment. Now, again, it's not just a passive investment vehicle. You do have to actually build out the operations of an Airbnb business. In all actuality, that's not too difficult, and the latest and greatest softwares make it a lot easier for you to do that. So I'm gonna rank this in two ways. If I'm a beginner looking to get into real estate investing and I don't have capital, I don't have the means to actually buy any property, but I really want a high cash flow vehicle, I'm putting this in S tier. But for anybody else that has capital, that's looking to get into more complex real estate investments, and they're looking for the best return on their money and really own equity, then I'm just gonna drop this down to A tier. So for the sake of this video, I'm gonna straddle it in between A and S. Next on the list is what's known as Airbnb co-hosting, or short-term rental or vacation rental co-hosting. So this is different from arbitrage, and this is essentially like property management. This is when you find a property that a landlord already has listed as a short-term rental, or they intend on listing it as a short-term rental, and you offer to run the property for them on the Airbnb platform or similar. And then essentially you collect a percentage of everything that's brought in each month. Now, this is by far, in my opinion, the best beginner strategy for real estate because there are zero upfront expenses, literally nothing outside of creating your LLC, nothing. You don't have to buy furniture. You don't have to sign any lease. There is literally zero risk, zero monthly expenses on your part. You can start tomorrow and cash flow tomorrow. And the second is there's just really no risk because you don't have any investment on the line. There is quite literally nothing that could go wrong. Even if the property did way worse than expected and you didn't run it the right way, you don't lose any money. Now, the landlord might not be happy with you and he might shred up the contract, but you still didn't lose anything outside of your time. So the caveat here is that you find a good profitable property to increase the amount of money that you'll make with this and your likelihood of success. But otherwise, there's no downside to doing co-hosting and there's plenty of opportunity. As a matter of fact, Adam, myself, people inside of our mentorship community crush it with co-hosting because they actually find properties that aren't even listed as short-term rentals. They find regular rental properties and then convince the landlords to list them as short-term rentals and co-host them. Because if you go to a landlord and say, hey, your you're asking $2,000 per month in rent with this, what if I was able to make you $4,000? That opens up way more opportunity than any other real estate investment vehicle. That's another pro of Airbnb arbitrage and co-hosting, is there is a way larger abundance of opportunity than any other sort of investment vehicle, because we're really just going based on the amount of rentals in the area, which is pretty much infinite. The downside to co-hosting, again, is you're essentially running your own property management type business. So you still do have to build out the operational component, but again, because the Airbnb platform, because of the softwares, it's way easier than it looks. And if you find one good property that generates $100,000 a year on Airbnb and you have an agreement with the landlord to take 20%, that's a good $1,800 per month in cash flow, just pure profit for you. So the important thing is to be very selective about the properties here. The biggest mistake is just choosing ones that won't be profitable at all, and then you just waste your time. But again, there's really no risk. I'm gonna go ahead and put this in S tier. And finally, in the creative and low capital section, we've got rental arbitrage for mid-term rentals. So this is almost identical to what we just talked about, where we rent a property, and instead of listing it on Airbnb, we list it on a site like Furnished Finder, and we rent it out on a month-to-month basis. So we'll look for leases with travel nurses or insurance claims where tenants would stay there for 2, 3, 4 months at a time. Now, this is also a really great strategy, but I would argue it provides you all of the headaches associated with arbitrage without the same amount of cash flow and profit. The turnover is not as frequent because in Airbnb arbitrage, tenants are basically there daily, maybe several times a month, whereas in midterm rentals, you have one tenant over the course of 3 to 4 months. Now, this is not legal or financial advice. However, by doing midterm rentals, tenants are there for several months at a time, which means they now have full tenant rights, depending on the city or state that you're in, which means you now assume the same risk as a long-term tenant by doing this. So they have separate leases, they're subject to the same legality, and typically the cash flow profit margins are not as good as Airbnb arbitrage. I would argue if you're gonna do all that work, you might as well just do Airbnb arbitrage. Nonetheless, this is a great model. You can also adopt this for corporate housing as well. So this is kind of synonymous with master leasing, where you lease clusters of apartments, etc., and you kind of do the corporate housing model with that. Again, I would argue it's the same work as Airbnb arbitrage with less of the profit margin. So because of that, I'm gonna put it in C tier. Okay, now let's get into some advanced investor strategies. Next on the list is multifamily syndications. Now, this is a very misunderstood area of real estate investing. Multifamily syndications is when you essentially pool together capital with other investors. So you and family and friends or other investor friends, you pool together money to take down an apartment complex. So instead of taking your 50 grand and putting it towards one house that's worth $300,000, you take that 50 grand, you pool it together with 5 other people. Now you have 250,000 that you use as a down payment for a multi-million-dollar complex. I'm botching the numbers here a little bit, but the point is you guys are taking on a way larger equity play by taking on a much bigger project. Now, this does pose risk. Typically, these are all facilitated by one person, a syndicator. And that one person you are relying on to have done really good analysis and knows how to facilitate those types of deals. But I would argue that this is a step up from all other areas of purchasing real estate because you have way more equity. You typically cash out of these projects every 5 years or so, which means when they sell the project at a substantial upside, you get a large payout when that happens. And along the way, you get all the tax benefits, you get all the cash flow, which is more than a regular real estate investment property. So I like multifamily syndications with the caveat that whoever is actually facilitating it is good and they know what they're doing. Because the right leader on a multifamily syndication could make you a ton of money. And then the final upside is if you are just somebody who's investing in the syndication and not the actual facilitator, it is literally mailbox money. It's the most passive form of investing for yourself where you give them the cash, you let them worry about it, and you sit on your butt. It's almost like you bought a long-term investment property without the headache. I'm gonna go ahead and put this in S tier. All right, next on the list is real estate development. This is, of course, when you buy land and you build a home, multifamily, or apartment complex project. Now, each one of those is very, very different. I'm not gonna try to loop them all into one category. But guys, real estate development is no joke, okay? The pros are there is massive wealth potential. Like this is quite literally where billionaires are made. It also creates new supply in very strong markets. It can generate huge equity gains, like massive equity gains. But the downsides are, of course, the capital investment. This is not something that you can start with 50K. This is something that is likely going to require 7 figures. And then the timelines on these projects are very long, which prolongs significantly the return on investment for you and your investors. So the risk tolerance must be insanely high for you to do this. I'm not even going to begin to go into the permitting, the regulatory stuff. This is way more in depth than just like a fix and flip. This requires some serious skill. So development is where billionaires are made, but beginners will get absolutely destroyed, like quite literally crippled. So if we're looking at this purely from a return on investment perspective and long-term equity and wealth perspective, this would be S tier. If we're going to look at this from a practicality standpoint of you and me and everybody that we know doing this, I'm actually going to go ahead and put this in D tier. It's just way too advanced and inaccessible for the average person. For these final few, we're going to talk about some lesser known strategies. I'm gonna move through them rapid fire. Next, we've got REITs. These are real estate investment trusts. It's essentially like a stock unit, like buying a stock portion of a real estate investment project. So it's like buying a stock of a company that owns a large portfolio of real estate, like apartment buildings, office buildings, shopping centers, data centers. So instead of buying property yourself, you're just basically buying shares in the company. So the way that you get paid is actually through the dividends. So even though the stock price will just ascend naturally, you will also be paid residual dividends, kind of the breadcrumbs of the profits along the way. So it's extremely passive, like quite literally the most passive real estate investment vehicle. It's very easy to invest. You just do it through the stock market. Super low capital requirement, very diversified. The cons are you don't have the same tax advantages. You have zero control over literally anything. It's really correlated with the stock market, which, is kind of like, why wouldn't you just invest into an index fund anyway? And there's way lower upside potential than active investing. Gonna put it in D tier. All right, next we're gonna talk about short-term rental ownership, buying an Airbnb or vacation rental property. I am also very torn on this because I'm going through one of these projects myself. And the bottom line is it is very risky to do this. Reason being is in today's world, short-term rental properties and buying them in vacation rental markets are very competitive, which means if you want your property to be successful and generate that high cash flow, you're going to need to put money into it, and a lot. I've talked about this recently. I purchased a property in West Palm Beach, Florida. It's a very competitive market. Now it's projected to make a lot of money, but it was only after I put in about $150,000 into upgrades to the property, basketball courts, pool, garage conversion, all of this crazy stuff. So it's incredibly risky. I still needed a ton of capital to do it, but the upsides are also very significant. If it does what we projected to do, the cash flow will be substantial, like 3 to 5K per month at minimum. And then second are the insane tax benefits of short-term rental properties. I'm not gonna get into a long discussion about this in this video, but short-term rental properties typically can do what's known as a cost segregation study for the owner. So without totally botching this, bottom line is a short-term rental property would allow you to write off a very significant amount of taxes. Let me just put it this way. People making $100,000 to $300,000 a year in their W-2s can quite literally eliminate their entire yearly taxes by buying a short-term rental property and doing a cost segregation study. It's that significant, but you can only do that one time. So short-term rental ownership would be an A or S tier project, but the biggest caveat is that if you do not know how to properly analyze an Airbnb short-term rental property to project exactly how much it's going to make and your calculation is off, this will make this an incredibly risky venture. Incredibly. I really do not recommend this for beginners at all, despite all of the hype on social media. Even though I just put a ton of eggs in that basket, I'm going to put this in B tier. Okay, next we've got wholesaling real estate. Now, this has been incredibly popularized over the last few years on Instagram, social media. There's a ton of wholesaling gurus out there. And in theory, it's a great strategy. Wholesaling is when you find a property that is available for sale. And let's say it's being sold at $200,000. Wholesaling is when you go to the owner, you offer them $150,000. They agree. You go under contract at $150,000, but then you sell that contract for the $200,000 and you profit that $50,000. Again, extreme example, but in theory, it's a great model. Here is the catch. Because of all the gurus out there, it is ridiculously saturated. There are thousands of people every single month trying to enter the wholesaling space, and it is quite literally a cold call grind. You are cold call outbounding property owners that do not want to talk to you. The second they find out what you're doing, they do not enjoy it at all. They don't want to cooperate. You are bothering people. Yes, you can make a substantial amount of money in wholesaling, but I would argue that it's few people that are actually doing it. It does work, but again, you're signing up for a sales job and you will not reap the rewards for several months after starting this. And the second you stop wholesaling, the second you stop making money. I'm gonna go ahead and put this in C tier. And the reason I put it in C tier is because you don't need $1 to start, and anybody with hustle and is willing to start their own basically cold calling sales business can do this. So it's very, very accessible, but just be prepared to eat shit. All right, last two on this list, we've got seller financing, also known as subject to financing. So this is when you buy a real estate investment property without using a traditional bank loan. This is typically when the seller of the property acts as the bank. They allow you to take over the existing financing of the property. So let's say the seller owns $250,000 in their mortgage. You buy the house, the mortgage stays in the seller's name, and then you take control of the property and then make the payments. So the pros are, this is one of the only ways that you can truly buy property without having to bring any money to the table. And there's pretty flexible deal structures. Like, you're not doing a typical fixed rate and fixed payment schedule like you would with a bank. You're coming up with a more creative way to finance the property. Here's the downside. Very legally complex. Not many owners are actually willing to do do this. They usually have to be in a pretty desperate situation to agree to this. Requires a lot of negotiation skill, and typically subject to and seller financing deals do what's called a balloon, which is if you don't have it paid down in a certain amount of time frame, the amount of the payments go up dramatically, and this can get really risky depending on how large that ballooning is. When done right, this can be a very powerful strategy, but beginners often underestimate the complexity of it, so I'm gonna put this in B tier. Okay, last on this list, buying mobile home parks. Again, has been popularized recently. Very simple, you buy a trailer park, and there's actually some upside to this. The cash flow can be pretty strong, much lower competition than buying an apartment complex because there's way less people going after these deals. Many of the tenants that you'll have actually own homes and they just rent the trailer out the side, and it's actually in pretty high demand for affordable housing. The downsides, these are difficult to finance. You will very likely underestimate the amount of management involved, because if you think about it, you're essentially buying an apartment complex but of like lower income people. And if you really want to scale it, you still have to do like really large acquisitions and much more capital intensive. So mobile home parks are one of the better cash flow vehicles in all of real estate if you know how to operate these types of deals. I'm gonna put that in A tier. So guys, it has been getting dark as I've been filming this video, if you haven't been able to tell. But with that, I hope you found this valuable and we've given you some more to think about in your real estate investing journey. Now, if your goal is purely cash flow and you want to do it as quickly as possible so you can get your time back or generate a few $1,000s extra per month on top of your full-time job, and you don't want to spend a lot of capital to do it, hell, you don't even want to buy property to do it, there is tons of free content on this channel on how to start and scale your own Airbnb arbitrage and or co-hosting business with little to no money out of pocket, grow it to 5 to 10K per month. Now, if you're looking for one-on-one guidance, training, mentorship with us directly to help you build your Airbnb portfolio, then go ahead and just click the link in the description to apply to BRRRR to see if it's a fit. We've helped hundreds of 9-to-5ers do this all around the country, some making as much as $100,000 per month in revenue. So until next time, guys, good luck.